Welcome everyone to the Rosecut February market update. I'm joined by Mike. How are you, Mike?
Daniel, hi. Good to be with you. All good. Interesting times in markets. Very volatile. I think the new year has brought a different market regime. We're in this kind of wide trading range, which I don't expect to come to an end anytime soon.
Yes, I remember in the December version of this call, we talked about being cautious going into new year.
Exactly.
And we've now seen the US stock markets hit correction territory, which is a 10% drop from its peak. The non-US markets, so the UK, Europe, even emerging markets, they are doing better. One risk out there that is on people's mind right now is the Russia-Ukraine situation, which I don't think either of us has much insight into how that will eventually finish.
It's having a direct impact on markets in the sense that it's pushed up the price of oil, which adds to inflation. It's another issue for people to worry about. I mean, it's the closest potentially that big powers have come to some sort of confrontation in decades. So there is this quite grave strategic risk in the background. And I think it's sort of foolish for us to try and forecast events in and around Ukraine. I think what we can comment on is the extent to which markets have priced it in, and the oil price is one key indicator. The Russian stock market is another, and I think the overall risk is that the situation in Ukraine, combined with what's happening with inflation and different pronouncements from the Fed, is driving risk appetite lower. And typically, I think in markets, when you have big sell-offs like we saw in January was actually the worst start to the stock market of any year, going back in the last 70, 80 years. Markets often come back and they kind of retest or they come close to the lows. So I wouldn't rule out a bit more volatility in the next couple of weeks, actually.
Yeah, the inflation topic is one that we touched upon last month, but I think we can keep on going with it because it is such a big issue. Right now, the big impact is on the consumer. So while the Fed is trying to talk down inflation by saying we're going to bring in a lot of interest rate hikes, what we're essentially seeing already is real wage growth. So wages after inflation is now negative. The wealth effect from people feeling rich as stocks and crypto went up, that's gone. And now we're seeing some of the consumer sentiment surveys falling off as people get a bit more nervous about the future, and that will impact on economic growth and potentially bring down inflation in the future. Despite all of the way that it's calculated and stuff like owner's equivalent rent, the mechanism for calculating inflation might mean it doesn't come down as quickly as people expect.
Yeah, and I think what this has done, it's done a number of things. One, people actually have to pay higher prices, and that's leading governments to respond to try and dampen energy costs. It's leading to unrest in some quarters. I think the risk for central banks is that if inflation continues to be high, it gets sticky. And it's very hard to reverse, and you get almost a structural element. And that's why we're beginning to see some urgency now in parts of the Fed that they need to move quickly. Some people talking about 5, 6 rate hikes this year, even a dramatic 50 basis point rate hike in March at the Fed meeting. And I think as investors, the kind of things we would look for in terms of stress would be, are we seeing periphery bond yields rise in Europe? Are we seeing, importantly, credit stress in broader markets, credit spreads widening, high yield spreads beginning to widen as well? So for me, that's the crucial factor, because in the time since the COVID market collapse, we haven't really seen a reappearance of credit risk. And I think if that happened, that would have contagion across broader markets.
Yes, it's true. The amount companies pay to borrow money, so the credit side of things, as you mentioned, that's really not showing the same signs of stress as the equity markets. So it's unlikely the Fed's going to move yet. I've seen people talk about the idea that the Fed is trying to almost thread a needle here because it's such a difficult job they've got. They're trying to bring down inflation on the one hand, but on the other hand, we're also seeing bond markets starting to price in the potential for a recession in a year or two's time. And this is determined by looking at the difference between the yield on short-dated bonds and long-dated bonds. which has historically been a reliable indicator. The problem the Fed has is they've got to bring down inflation by raising interest rates, but if they raise them too much, they potentially cause a recession, which means that they get criticised again.
This is why the Fed is so criticised, that people use the phrase they're behind the curve. And what that means is that they should really have tightened, or certainly maybe stopped doing aggressive asset purchases some months ago, even a year ago. Whereas now the fact that they're forced to catch up with inflation and make some potentially dramatic policy action could mean that they jeopardize the overall recovery and tighten too hard, and then you begin to kill off growth. So it's the Fed have really painted themselves into a corner. And I think the same is true of some of the other central banks as well. Notably in Europe, the ECB seemed to be very cool on the prospect that inflation is any kind of problem.
Yeah. So to end the update on a more positive note, whilst we can see within the market some sectors such as those concentrated on the consumer have been suffering, the position that we took in November 2020 in the energy and value ETFs have really performed very strongly.
It was a really good move, actually.
Yeah, and that's really helping to insulate the client portfolios from the overall market moves. So I was looking at some of the stats earlier, and most of them are down 2 or 3% year to date, whereas the US market is down 10% more. So our positioning looks okay. I think we'll probably be running with a similar position with respect to equities for some time.
Yeah, I think so.
Okay, well, thank you for joining us, Mike.
To chat about, I'm sure, in the coming weeks. So I look forward to catching up again in a couple of weeks' time.
Great. Thank you, Mike.
Okay, thanks, Daniel. Bye-bye.